All right, let's talk about a massive, impossible contradiction hiding right in plain sight within the American economy. You hear it on the news all the time, right? You see these glowing, incredibly positive headlines, and yet for millions of people, those headlines feel like they're describing an entirely different planet. So today, we're going to follow the data to unpack exactly what's happening just beneath the surface of what's being called the greatest economic boom in history. If you just look at the numbers, we're living in literally one of the richest moments in US history. I mean, the stock market has hit its 23rd record high this year alone, and the national net worth has never been larger. It's a boom. But here's the wild part. Consumer sentiment has plunged to its lowest level ever recorded. People are actually feeling worse about the economy right now than they did during the 2008 financial crisis. They feel worse than during the pandemic lockdowns.
So let's dive into part one, the great economic paradox, a real tale of two economies.
This whole disconnect between the big macroeconomic headlines and our actual day-to-day reality, it's perfectly captured by, well, probably the most boring account in America, your standard 401k. On paper, things look great. The average 401k just hit a record high of over $160,000. But wait, while those balances are peaking, a record number of people are simultaneously reading those exact same accounts. They are choosing to pay incredibly harsh early withdrawal penalties just to get their hands on some cash. Roughly 6% of savers have dipped into their retirement early, which, to put that into perspective, is triple the rate we saw before the pandemic. Now, when you actually break down the reasons behind these hardship withdrawals, it gets pretty dark. These aren't, luxury cash outs to go buy a new boat or take a vacation. No, 36% of these folks are desperately trying to avoid foreclosure or eviction. Another 31% are just drowning in medical expenses, and 13% are simply trying to cover tuition. It really forces us to stop and ask, how on earth can the economy be booming while average citizens are literally raiding their own futures just to survive today? Which brings us to part two, the ownership illusion. Who actually owns this boom? To understand how an economy can just roar while its citizens are struggling, we really have to follow the paper trail. Because here's the thing, when the markets climb, those trillions of dollars in new wealth don't just fall evenly on everyone like rain. According to the Federal Reserve, out of the 134 million households in America, the top 10% own a staggering 87% of all stocks. That leaves the entire bottom 90%, we're talking teachers, nurses, bus drivers, everyday folks, fighting over just 13% of the pie. Now, you might hear people say, but hey, 58% of Americans own stock. And sure, they do. But owning some stock and owning enough stock to actually change your life, those are two completely different realities. The median stock holdings for the bottom half of the country sit at just $13,000. For the top 10%, it's $600,000. That is a massive 48-fold difference. Let's put some actual dollars to those percentages so we can really see it. If the market goes up by a standard 16%, the bottom half of the country sees a paper gain of maybe $2,000. Meanwhile, the wealthiest households pull in nearly $100,000 in a single year. So the stock market itself might have been democratized, sure, but the actual wealth, not even close. All right, part three, the rise of survival debt, borrowing from the future. See, if you don't hold those big assets that are going up in value, you are living a vastly different reality right now. On paper, average hourly earnings recently went up 3.6%, which sounds great, but inflation rose 3.8% over that exact same stretch. So inflation literally ate the raise before it even hit the bank account. To bridge this massive gap, Americans are having to turn to the future. We've collectively racked up a staggering $1.25 trillion on credit cards, and that's carrying an average interest rate of 23%. And that brings us to a really chilling new reality. Bankrate found that a full third of people carrying credit card debt are using it strictly for day-to-day expenses. They aren't financing fun vacations or chasing airline miles. They are trapped in what economists are now calling survival debt. Mike Croxon, who runs the biggest nonprofit credit counseling network in the country, hit the nail on the head. He pointed out we are seeing a disturbing shift from discretionary debt to survival debt. When you've got 61% of people stuck carrying these balances for over a year at 23% interest, there's almost no mathematical way out. It's a trap. And to cover this day-to-day survival, there's a new kind of short-term financing spreading like absolute wildfire. You've definitely seen the option when you're checking out online, right? By now,
pay later. It's a system designed to split a purchase into 4 smaller installments over time.
Now, buy now, pay later used to be for, buying a new couch or grabbing expensive concert tickets. But today, over 90 million Americans are using it. And this is the shocking part. More than a quarter of those users are relying on it just to buy their weekly groceries. More than half say they literally couldn't make ends meet without it. People are actually financing a trip to the grocery store or splitting a fast food burrito into 4 easy payments just to make it through the week. No way around it. That's incredibly bleak. Because everyday costs are just so punishing right now, the ultimate safety net is basically vanishing. The US personal savings rate has plummeted down to 2.6%. That's down from 5.5% just a year ago, and it's sitting near historic lows. And actually, the reality is a whole lot darker for the bottom 65 million households. For them, the savings rate is actually negative, meaning they're spending more than they bring in after taxes, sinking a little deeper into the red every single month.
Moving on to part 4, the E-shaped economy. 3 different classes, 3 very different lives.
For years, economists loved talking about a K-shaped recovery. That's where the rich get richer on the top arm of the K and the poor get poorer on the bottom arm. But if we look past those glowing macroeconomic headlines we talked about earlier, the data really forces us to ask, what is the actual true shape of the US economy today? Well, it turns out the answer is an E-shaped economy. Think of a capital E. The top bar, that's the ownership class. The top 10% pulling away, holding 68% of the total net worth. The bottom bar, that's the survival class, way down on the floor. The bottom 50% trapped in that survival debt we just discussed. And then there's the middle bar, the squeezed middle 40%. But here's the catch. This middle bar isn't straight anymore. It is dangerously tilting downwards.
And that downward tilt, it's actually a quiet but massive migration. As inflation just completely eliminates their breathing room, the middle class is slipping. Chief economist Heather Long points this out perfectly. She notes that families are being forced to abandon those premium experiences like Whole Foods, and they're migrating over to discount stores like Costco and Aldi, just trying to maintain their baseline standard of living.
Ultimately, this E-shaped split is exactly why the national news and your personal bank account just never seem to match up. It's the same country, sure, but we are absolutely living in completely different Americas right now. So I want to leave you with this final thought to chew on. As this gap just continues to widen, which bar of the E-shaped economy are you standing on?